set up this presentation so that I will cover the basics, and then depending if I have time, I will keep going. I prefer when people ask me questions. So I would prefer it if you interrupted me. Okay? But if you don't interrupt me, I'll leave some time at the end. But I would prefer you to interrupt me and ask me questions. Okay? All right. So what I would say is, so let me just give some attribution here. I'm going to talk about 4 papers, time permitting. I'm not sure we'll get there, but certainly these 2 papers are going to form the core of the presentation. So just want to give attribution to all the co-authors that developed this with me. Rick Green, and Jules Van Binsbergen and Ben Ying Louis. Okay. So here's the outline of the presentation. So the first thing I want to do is describe to you how the money management equilibrium works. Then I'm going to provide, once I've described the equilibrium to you, I'm going to run it, I'm going to show the empirical evidence that is in fact how the equilibrium works. And that if you think about it correctly, what you come to the conclusion opposite to what many people believe is that mutual fund managers are highly skilled. Okay? Then finally, I'm going to show you that investors know this and they reward the skill. Okay? Let's see why that's true. So if you go back historically to the way people thought about mutual funds before, then I would say there were these 2 opposing ideas. Okay? They were mutually exclusive. One was that, first, when you're a PhD student, the very first course in microeconomics you take, this is the main principle you learn, which is that, only people with a skill in short supply earn economic rents. So cornerstone of microeconomics. And then, what used to be the cornerstone of mutual funds was that mutual fund managers lack skill. Well, obviously these 2 are not consistent with each other, because if mutual fund managers are amongst the highest paid members of society, so if they lack skill, then we have an example of somebody who is earning rents but doesn't have a skill in short supply. So one of these 2 is wrong. Okay? So my first talk is to show you that in fact this paradox is easily resolved. This is wrong. We don't have to give up microeconomics, okay? That the problem was that people were not applying the rational expectations paradigm correctly to mutual funds. A lot of people call the rational expectations paradigms efficient markets. So another way of saying that is people were not applying the efficient market hypothesis correctly to mutual funds. So let's see why that is. So I don't use the word efficient markets because it's not very useful, because it's not well defined. Pointless to have a term that's not well defined. Then one person talks about it this way, another person talks about it this way. So I strongly suggest you don't use the term anyway. But in the context of this, let me try to understand what people meant by the term. Okay, so my definition of what people mean by the term is your grandmother is wrong. What the hell do I mean? Okay? Your grandmother calls you about a new product she just noticed in the store, and she says to you, "A fantastic product, I want to invest in the company." And you say, "Granny, sorry to disappoint you, but you're not the first person who noticed this." Okay? People knew about this even before the product was introduced. And the stock price already reflects this information. It's pointless to invest. You're not going to make any money. Right? So what is that? That's the idea that the markets are so competitive, right, that the quality of the company, the quality of the management of the company is reflected in the value of the company. Good companies have a high value, right? Because of that, the expected return of the company tells you nothing about the quality of the company. It just tells you about the risk of the company. That's what I would say most people think of the efficient market hypothesis. I would call that the rational expectations paradigm that we all work under. Okay? That's the principle. Now, this principle is so well accepted that in a court of law, you can use it as evidence. So, somebody has been hurt by something, and what happens? We say, what happened to the stock price? The change is the damages. So that's how well accepted it is. Yet, People were not applying this in the mutual fund space. Okay? So if you go to mutual funds, historically, people had a completely different view in mutual funds. In mutual funds, the size of the fund was random, and the quality of the fund manager is reflected in the fund's expected return, the alpha. Exactly opposite of what we just said. Right? And clearly that's inconsistent. And it makes no sense because mutual fund investors and equity investors are essentially the same people. So you're making this claim that one market consists of a bunch of people who are fully rational and we have an equilibrium. And then those same people move to another market and they're complete idiots and we're in a different equilibrium. So that makes no sense. Okay. Okay. So I just said this. So why did we make this mistake? Well, it actually is Gene Farmer who made the mistake. It started with him. Okay. So, if you look at all of these efficient market papers, they all do the same thing. He basically says, look, I'm so certain that the efficient market hypothesis does explain the world that I'm going to show you even the people who claim to know don't know. So he looks at the return to mutual funds and he goes, look, these people, the mutual fund managers are not outperforming. So they don't even know what they're doing. So nobody knows what they're doing. That's a completely incorrect argument to make, okay? So let's see this. So if you follow that argument and you use the net alpha to measure the quality of the manager, that's the same thing as using the stock's return to measure the quality of the company. You're making the mistake of your grandmother, okay? Like a stock, the expected return of a fund is determined only by its risk, which means the alpha has to be zero. That is the efficient market hypothesis, right? That's what the efficient market hypothesis says. It says the alpha must be zero. That the only thing that determines the expected return of the fund is the risk of the fund. It's very hard. I mean, look, I'm an old man these days, I have to say. I don't feel like an old man, but I have to say sometimes I do. Because, I'm very crotchety because I look at finance today and I think part of the reason, especially with asset pricing, that we're in this, bad situation of bad papers over bad papers over bad papers going nowhere is precisely because we do not take ourselves seriously. We don't take theory seriously. The efficient market hypothesis is not a theory. If it was a theory, the person who developed it would be able to apply it. Right? I mean, it's pretty unbelievable that the guy who claims to have developed this theory can't even apply the theory, his own theory. Yeah. Yeah.
Unlike a stock, okay, the price is great, so we price it higher. But mutual fund share price is just NAV. It has nothing to do with who's managing the fund.
Yes. So we're going to solve that in a second. But we just want to make it clear. How does this equilibrium work? It's not that the expected return is going to tell you anything about the manager. So we have to figure out how does the rational expectations equilibrium work in mutual funds? Yes. But it's the same as stocks if you think about it. Because what happens to the stock? The size changes, right? Because when it's a good company, people demand the company and the price goes up and the same thing happens. The size of the company goes up. It's actually not that different. Yeah. Market value. Always market value. Yes, I know. Another interesting thing. So let's answer your question, okay? So the first thing to realize is mutual funds are not an exceptional industry in any way, shape, or form, and every single industry must face decreasing returns to scale. Otherwise, that industry would take over the whole economy, right? There must come a time where you face decreasing returns to scale, right? I mean, if you ask me exactly how does that work in mutual funds, well, I would say there are two mechanisms. One mechanism is the mutual fund manager gets more money. He can either trade the same stocks he has already. And if he does that, he's going to push the price against him more, so he doesn't make as much. Or he could pick a new stock to trade. Well, obviously, he's working down his own productivity curve, right? The best deals he's already taken. So if you ask him to take another deal, it's not going to be as good as the previous deal. So again, he's going to face decreasing returns to scale. So that's one of those two mechanisms. Now let's imagine the world, the grandmother's world. So let's imagine the case that the mutual fund had a positive alpha. What would happen? Well, everybody wants a positive alpha, right? Another way, when I teach competitive markets to MBAs, what I say to them is, there are no positive NPV projects in capital markets. That's the statement that you really want to make. There are no positive NPV projects in capital markets, right? Because everybody wants a positive NPV project. If the alpha is positive, we are faced with a positive NPV project. So everybody wants that. It can't survive. So people will start demanding the mutual fund, which means, as you say, there's no price. The price is fixed. The price is fixed at NAV. It cannot change, right? So what happens is the money flows in at NAV, but the future return now is decreased, right? Because the manager, when he puts that to productive use, won't be as good. So what eventually happens is the expected return drops and drops and drops until it hits alpha equals zero, until it hits zero, the alpha is zero, in which case nobody wants to invest anymore. And we're in equilibrium. And that's the equilibrium, okay? So just as in efficient markets, the size of the fund is the signal of the quality. The return tells you nothing about the quality, right? Okay, so that's the static world that I just described, but the world isn't static, it's dynamic, right? So how does the dynamic version work? Imagine we're in equilibrium. All mutual funds have a zero alpha. Sizes have adjusted. We're there. Okay? Now imagine some news comes in. Now, the most obvious piece of news is what return did the manager make? Right? If the manager did well, beat his benchmark, right? Well, that's good news. So something, it might not adjust the people's expectations very much, but it's going to cause them to adjust it some, right? So now what happens is people say, well, okay, this manager was better than we thought he was a period ago. If nothing changed, that fund had a positive alpha, right? So the only thing that can happen now is, we're not in equilibrium, so the only thing that can happen now is the funds will flow in. How will those funds, they will flow in until what point? Until under the new expectations, the alpha's back at zero. Right? Similarly, if the manager did badly, okay, people will say, well, this is a negative NPV project. We don't invest in negative NPV projects. So they pull their money out. How much money do they pull out? Well, as they pull their money out, the alpha goes up. And again, people stop pulling their money out when the alpha hits zero. So, that in the dynamic world, alpha is always zero, but you get the flow of funds relation. Right? So prior to the paper I wrote with Rick, people used to say, Thaler used to walk around, he used to say this all the time. Anytime he had to talk about behavioral finance, he would say, I'll give you an example of how stupid investors are, right? He would say, investors, we know that the returns are unpredictable, we know alpha's unpredictable, yet the flow of funds follows past performance. Investors are chasing past returns. He has that exactly the opposite. It's the other way around. The reason returns are unpredictable, the reason alpha zero in expectation is because investors chase past returns. Yeah. Yes, there's always infinite supply of capital for positive NPV projects. That's the first most important assumption we all make. We don't say it. The idea, if you have the idea, what people call efficient markets, I call it rational expectations. If you believe that equilibrium is true, it doesn't come by magic. It comes by because there are no positive NPV projects in capital markets. And the only way there can be no positive NPV projects in capital markets is capital markets are so competitive, all those are being competed away, which means there's an infinite supply of capital for positive NPV projects. Which I think is a fine assumption, by the way. You know, whenever I hear people say, oh my God, I can't get funded, markets are illiquid, it reminds me of when I have season tickets to the Giants, 83 games a year, right? I can't go to 83 games a year, I have to sell most of them off. You cannot believe how, if I put a high price on those tickets on StubHub, you cannot believe how illiquid StubHub is. When I put a low price on those tickets, you have no idea how liquid it is all of a sudden, right? So my view is when people start complaining about that they can't sell something, it's because they've got a negative NPV project, and people don't want to invest in negative NPV. But if you have a positive NPV project, there's no shortage of capital. There's an infinite supply of capital, which is the same statement that capital earns no rents, which is again the statement that returns are just a function of the risk. There are no rents to capital. Yeah, so I'll talk about that at the end. But if you can borrow money, it's not a problem. But you know, there probably are problems with borrowing money. So the young manager. But remember, the young fund also may not know his own ability. So he might have the right amount of capital given his track record. You know, later on, it might be the case that we find out he's a good manager. But the right amount of capital, before we find that out, he may even have the right amount of capital even then. But I'll talk about that. I'll talk about the role of mutual fund companies. And I'll show you that, in fact, the mutual fund companies perform a very important role in directing capital amongst their employees. Yeah.
So now, because everyone believes the previous version of the story, right? Which is
Hopefully they don't anymore, but anyway, yes.
This big exit of the capital flowing out of active management to mutual funds to passive funds.
That isn't true. That isn't true. That's a fact. You know, I mean, it's a bad situation because I'm really a crutchy old man, but I'll complain anyway. I got a paper to refer. Here's the truth. What people call passive, most of it is not passive. Okay? Because most ETFs are not passive investments. A passive investment is you invest in the markets. And ETFs are not market investments. They are calls because they'll be small stocks or they'll be sector stocks or that's not passive. When you make a call and you say, I want to invest in this sector, right? So it means the vast majority ETFs are not passive. And if you do the calculation correctly, where you correctly move between, correctly assign the ETFs to active and passive, you find that that's just not the case. That the amount in active is actually going up. And the complaint was I actually refereed a paper that made this point, which was rejected. I mean, at Journal of Finance. Too obvious. I mean, it's like crazy. It's like, I don't understand what you know, what's going on with our principle. When everybody thinks that what you just said, and then the paper makes this point. No, that isn't correct, and it doesn't get accepted. Anyway, it doesn't matter. Okay. Okay, so so we could ask the question, what do we learn from the net alpha? So, you know, you've got hundreds and hundreds of papers that use net alpha to measure skill. Well, that clearly isn't true. They're not measuring skill, right? So what do all those papers tell you? What those papers tell you is they tell you nothing about the skill of the manager. What they tell you is about investors, right? So if you found a positive net alpha, then that would be the statement that markets are not fully competitive, that there's a shortage of capital, okay? If it's negative, it says some investors are irrational because they're investing in negative NPV projects. And if it's zero, it means markets are competitive, investors are irrational. And I'm going to show you today, this is what we find. If you do the research properly, you will see that the net alpha is zero, just as the theory predicts. Okay. So, people, you know, after Rick and I wrote the paper, people said, oh, some of them actually realized that they were making a mistake. There's no problem. We're going to use gross alpha, right? Turns out gross alpha doesn't work either. The gross alpha tells you absolutely nothing. Okay? And the reason is, I just finished this because I'm teaching right now, making this point in my MBA classroom. You cannot use the IRR as an investment rule, right? Why not? Because the IRR ignores scale, right? So it's the same thing here. You can't use the gross alpha to determine the quality of the manager because it ignores scale, right? What would you rather, a 100% return on $1 or a 10% return on $1 billion, right? So you can't use the gross alpha. So I've, in my long, in thinking about this for many years, I've decided that this is the kind of thing you have to beat to the ground. So I'm going to beat this dead horse. So let me explain to you exactly what's wrong with gross alpha. Okay. the fact is that gross alpha isn't even necessarily positively correlated with skill. You might think, well, at least it's positively correlated with skill. In fact, even that isn't true. Okay, and let me see why. So we understood the net alpha 0. Right, I've convinced you of that. The net alpha 0, okay? So the net alpha 0, what is the gross alpha? It's the net alpha plus the fee, right? So what, I'm sorry. The overall return is the net alpha plus the fee. So the gross alpha is just the fee the manager charges. Well, the manager gets to pick his fee. Okay, so it immediately tells you if he's picking his fee, it can't be a measure of skill because you can't pick your skill, right? So the question is, to get the result that gross alpha is positively correlated to skill requires additional assumptions, okay? And what are those additional assumptions? Okay, let me just work a simple example. So if gross alpha is, so here's the equation. So this is the equation that we use. It's a simple equation. It's a simplified version of the decreasing returns to scale. So it says gross alpha is a constant minus a term that reflects the decreasing returns to scale, and we assume it's linear, right? If you assume that process for the gross alpha, then what we call it the value added, which is just the gross alpha times the size, that way we get rid of this scale problem, okay, is this number here. And we're going to assume the manager wants to maximize this because the manager wants to maximize the total dollars. So if the manager maximizes the total dollars, then the optimal amount of money for the manager to manage is just going to be A over 2B. It's a simple quadratic maximization problem, okay? Now, plug this back in here. What do you get? You get that the gross alpha is A over 2. Notice it doesn't depend on B. Meaning I can have two managers of different skill, but they'll have the same gross alpha. Let's see that on a picture. So here are the two managers. They both have the same, they have the same A, but managers 2B is twice manager 1. So they both have the same initial amount, but the one manager's better at, has a decrease in returns to scale. It doesn't drop off as much, right? Which means the better manager should manage more money, and he does. So that's where the better manager manages. And this is the value added of the better manager. This is the value added of the worse manager. But however, if you look at the net alpha of these managers, it's the same, right? So here is the gross alpha of these two managers is the same because they are managing two different amounts of money. So if you calculate the gross alpha, here's the gross alpha of the first manager, and here's the gross alpha of the second manager. These two numbers are the same. Okay. So let's think about the two extremes, okay? You can think about two different worlds. In one world, gross alpha is going to be highly correlated to skill. In the other world, it's not. Okay? So let's think about these two worlds. So I've only spoken about the one method where the market can equilibrate, which is what happens is as the new information comes in, the size of the fund increases. There is another possibility. Okay? Instead of the size of the fund increasing, the manager could change his fee. Right? So we can imagine these two worlds. Okay? So let's think about it. So let's think about the world where the size stays constant, and then the manager changes his fee every period to bring the net alpha to 0. Okay? Now, in that world, what are we going to see? We're going to see very little cross-sectional variation in size and a lot of cross-sectional variation in fees. And that world, the gross alpha will be highly correlated because remember, the gross alpha is the fee. Right? Or we could do the world I described before, which is fees are the same across managers and AUM adjusts. So that's a world where there's little cross-sectional variation in fees and large cross-sectional variation in AUM. And in that world, gross alpha tells you nothing because all managers have the same fee. It just so happens that's the world we live in. Because if you look in the data, what do you see? You see low cross-sectional variation in fees and high cross-sectional variation in AUM. So we live in the world where gross alpha tells you nothing. Okay, so you can't use gross alpha to measure the quality of the manager. So as I said, the only way you can measure skill is to look at how many dollars does the manager make. Another way of saying this is you use the NPV rule. Okay? Yeah. right?
The fee belongs to the manager.
Yes.
But the alpha belongs to
The investors, exactly. So right. So the alpha, if you ask the question, how much money do investors make? Then you have to look at the net alpha, because that's the measure of what investors make. And that's the question I said before. That's the question, is how competitive is the mutual fund space? Right? So if you want to ask the question, how competitive is the mutual fund space, then you need to look at the net alpha, at the return to investors. You want to ask the question, how skilled are mutual fund managers? Then you have to use value added. Of course, the money's going to the mutual fund manager, right? Because the value added, I just told you the alpha zero. If the mutual fund manager is adding value and the alpha zero, there's only one place that can go to. It goes to the manager. But that's perfectly fine. That's the way the first principle of microeconomics works. If you have a skill in short supply, you get all the rents. So the fact that the manager is getting all the value added is the equivalent statement. He's getting all the rents, right? So everything works. It all fits together the way it's supposed to, right? Okay, so what is the value added? Well, I'm going to get to how we calculate the benchmark. So just assume we know how to calculate the benchmark. It's correct. Then it's the gross return minus the benchmark, right? Okay, times the size of the fund. So this is what the manager adds, okay? And so what is that? That is going to be the gross return is the fee plus noise, right? So now let's think about this. This is always positive, right? The expectation of this term depends if we're talking about capital markets. If you're talking about fully rational capital markets, then this has to be zero, which means V is positive. If you go to Farmer's view of the world, what's Farmer's view of the world? Farmer's view of the world is that managers have no skill, right? Well, then the manager has to underperform exactly by the fee, right? So this is zero. Another way of saying this is if you do a measure and you get a positive number here, the only way that number can be positive is if the manager adds value. There's no other way to get a positive value added unless the manager adds value, right? Yeah.
Related to this question, so is this value added also a measure of how much mispricing is corrected by the fund manager?
Yeah, so I don't like that question from the following perspective. I don't know why we call it mispricing. There's going to be an equilibrium, okay? The idea that there's nobody can beat the market is completely ludicrous. The most smartest person in the world must be able to beat the market. He's smarter than everybody else, right? So the statement that nobody can beat the market is just completely mad, as far as I'm concerned. But the better statement is most people can't, right? Because so the smartest person can, maybe the second smartest person can, but then the second smartest person starts competing with the smartest person. So eventually, very quickly, we're going to run out of people who can beat the markets. They'll compete with each other and the information will come out. So what this is a measure of is how of the smartest people in the world being able to make money in markets. But I wouldn't call that mispricing, right?
So using the term making money, basically means there is some money left on the ground.
Only for the smartest people. Right? I mean, that's fine. What do we think? This world is not, smart people can't make money? Of course they can. But it's only the smartest people. It's not us. Okay? Or, if I would say the following, that my guess is the average finance academic could probably enter the space and make money, right? But it would take 10 years of experience and a lot of work, right? I mean, nobody can enter the space and make money just off the bat. Nobody's that smart, right? But if you put your mind to it and you worked hard, then eventually, you'd get this. You get the skill that you needed, but not a lot of people can have the skill, because if there were a lot of people, they would compete with each other, and then the alphas would be zero. It has to be a limited supply of people, right, that earn rents, and this is the measure of the rents. I want to emphasize, this is very important, that this measure does not depend on the rational expectations equilibrium holding. If this measure is positive, the only way it can be positive is if managers add value. The reason is it's a zero sum. There's an accounting identity which says the money that the manager puts in his pocket can only come from one of two places. It can only come from either his skill or from investors. And so if this term here is zero, then this is positive. So the only place it can come from is skill. If it comes from investors, this term here has to be the negative of that term. But it doesn't depend on any rational expectations. Right? If this term exceeds this term, then that must be a measure of skill. Right? And so this is not a rational expectations thing. If B is positive, the manager must be skilled. Right? Another important thing to realize is the fees. So people make so much fuss about fees. Fees are irrelevant. Why? Because the fee only determines the size of the fund. There's that double thing there is a PDF problem. It's supposed to be a single. That's not a second derivative. That's a first derivative. Okay? But so the fee only determines the size of the fund. The manager could charge a high fee and manage a small fund, or he could charge a low fee and manage a large fund. I mean, a lot of the fuss about passive investing or the growth of ETFs, it's just because they have low fees. So if they have low fees, the size of the fund goes up. Right? It doesn't tell you anything about the underlying quality of the manager, what the fee the manager charges. So it's an important thing. And often when you see people write mutual fund papers these days, they'll often derive this. They'll say, and the fee is irrelevant. I'm like, no, it's always irrelevant. It's not just your model. Okay. All right. Let me just do one, make the point very literally. So Peter Lynch is the most successful money manager of all time. Okay. And people used to look at his record and they used to say, everybody thinks he's successful. He's actually the luckiest man alive. And here's what they would say. They would say, in his first 5 years, he had a 2% monthly, 24% a year, 2% monthly gross alpha. Okay? In his last 5 years, it was 20 basis points. So people would say, pure luck. Now, let's calculate the value added, okay? Because the problem was, in his first 5 years, he was measuring 40 million, and his last 5 years, he was managing 10 billion. If you calculate the value added, in his first 5 years, his value added was $1 million a month. In his last 5 years, it was $20 million a month that guy was generating. Right? So his reputation as the most skilled manager of all time is absolutely correct. It's amazing that he could generate a gross alpha on assets of, at that time, $10 billion. It was a lot of money in those days, right? So he was. So if you look at it correctly, it's absolutely correct. He was the most skilled mutual fund manager of all time. Okay, let's get down to empirical work. I'm not going to show you that the equilibrium is in fact true. Okay? To do that, I have to do a couple things. The first thing I have to do is measure the alpha. To measure the alpha, you need a risk adjustment, right? Now, the problem is that we have no idea how to adjust for risk. Just all accept that fact. So one thing you could do is just ignore the problem, pretend we do know how to adjust for risk. And so I'll do that. And I'll use the Farmer French Carhart so-called model to adjust for risk. Now, but if you read the mutual fund literature, what people will say is they understand that there's no reason in the world that this is a risk model. So what they say there is, who cares if it's a risk model? The investor, can invest in these portfolios himself, right? So even if this isn't a risk model, the manager has to at least beat this, right? So that's what I would call the next best investment opportunity approach, which is construct the next best investment opportunity and then compare the manager's return to that opportunity. And then you sidestep the risk model. And that is, in fact, I think, the best way to approach this. The problem is, unfortunately, this is not the next best investment opportunity. The reason it's not is these portfolios do not do not contain transaction costs. You can't compare a manager who's paying transaction costs against a strategy that doesn't pay transaction costs. That's ridiculous. So we need to construct that. Now, there are two reasons, okay, why these things don't include transaction costs. The first is it just doesn't include transaction costs. The second is these portfolios were discovered in the 90s. The mutual fund database goes back to the 60s. If you knew about size in the 60s, that's called skill. So you can't use 1990s technology on a manager in 1960. So there's another reason why this is not the legitimate way to measure the skill of the manager. So what we're going to do is the following. We're going to say, okay, we need an investable benchmark. So one investable benchmark is the Vanguard index funds that existed. The second thing is, when an index fund exists, we feel as if the strategy is well known enough so that it's not skilled if you figure out that strategy. So the introduction of an index fund by Vanguard is our signal that the strategy is a strategy that investors could invest themselves in. And so that's what we do. So we construct every month an index of Vanguard, a portfolio of Vanguard index funds. Okay? Here are the funds we use, right? And as you can see, they were introduced at different dates. So before 1987, the only thing you had was these two funds, which is the S&P 500 and an extended market index. And then 1990, you had, small cap, international, it was, as these things were introduced. So another way of saying this is if you knew that small cap stocks were high returns prior to 1990, we're going to call you skilled. After 1990, we're not going to call you skilled anymore. And that's what we're going to do with all the Vanguard index funds. So the first problem solved. How are we going to measure skill? We're going to measure skill relative to whatever Vanguard was offering at the time. Okay? The second problem is a pernicious problem that entered this literature for no good reason, which is that for reasons that nobody has ever justified, the standard approach is to throw out a third of the data. Okay? So for some reason in this literature, people only look at U.S. equity funds. Okay? So what does this mean? It means if the fund invests $1 in a foreign stock, it's thrown out. I don't understand why anybody would do that. Sometimes I hear questions like, well, people say, well, but then wait a minute. We don't know how to price foreign stocks. Okay. Well, first of all, we don't know how to price U.S. stocks either while we're on that subject, right? But if you have an asset pricing model, it's supposed to apply everywhere. But even ignoring that argument, it's not consistent. Because if you think the asset pricing model prices Apple, well, Apple has tons of investments overseas. So if the asset pricing model prices Apple, then it also prices a mutual fund that's traded in the United States that happens to have investments overseas. Right? So that makes no sense to throw out that data. So, and it makes a difference. It's not like this is innocuous. When you throw out the data, you get different results. So, the second thing we're going to do is not throw out the data. We're going to use all the funds, which means we're going to have a very large sample size. We're going to have 6,000 funds in the sample, as opposed to usually the typical thing only has 2,000 funds. Right? Yeah, that's a good question. It's a good question. But we agree. If you have a full data set, then you look at the full data set, right? Now you can ask why it's different in subparts of the data. I'll have something to say about that later on, but that doesn't mean you look at the subpart and you use that as the general thing. You use the full data set. You don't get to cherry pick which part of the data set you want to use. Yeah.
No, that's the follow-up that question is that because the some such as emerging or other emerging market, it's not just earned in the US, then what else?
What's the what?
So it's not only just focused on US equity.
Yeah.
Right? So and that could affect the result.
Yes, it does.
And so the answer is that nothing because the emerging market are kind of return.
Well, it means that the smart managers moved international. The dumb managers stayed in U.S. equity. I don't know why that was, right? I mean, people didn't know it, but that's what it means, right? Okay. So here's how the empirical work's going to work, okay? So for every single fund in every single period, I'm going to measure value added, which is just going to be whatever the return minus the benchmark is times the size of the fund, every single period. And then I'm going to average that over the life of the fund, and I'm going to call that the value added of the fund, okay? Then I'm going to average across all funds, and that's going to be the average skill. Now, that's the measure of the ex ante expectation of managerial skill, right? But you could think about it as another measure, which is the ex post, which is because what's going to happen is once managers start managing money, the good managers will survive and the bad managers will fall out. So the actual data is biased. And we could ask, what is the average skill level of surviving managers? So that is this, but weighted by the amount of time the manager is. Another way of saying that is you add up, you don't divide by N, you just add up you add up all of these for every single manager across the whole data set. And so the managers who've been there longer get higher weight than the managers who've been there shorter. That's this number here. So I will give you both. I will give you the ex ante average and the ex post average. Right? So here's the answer. So if you do that, okay, so now we're in dollars, right? If I want to measure the skill of the manager, I have to measure the skill in dollars, right? So that means I have to worry about when are the dollars actually occurring. So the dollars are year $2,000, and it's in millions of dollars per month. Okay? And if you do that, what you find is that the average manager adds $140,000 a month ex ante, and ex post $270,000 a month, right? So it's approximately the average manager adds $2 million a year. There's very, very strong evidence of a lot of skill in mutual funds. Now, an interesting number is this, that the 50th percentile is essentially zero, meaning most managers don't add any value. The reason the average is positive is because investors correctly assign capital. The dumb managers don't have much capital. Most of the capital is with the smart managers, and that's why the average is positive. And this is a constant theme I'm going to harp on throughout this talk. Okay, so when Farmer wrote the very first paper, he was so happy to see the alpha was zero, and that meant that in his mind that the efficient market hypothesis was correct. And then he really nailed it in his mind, because what he said was, look, maybe I just don't have enough power, and the alpha is zero, right? I want to show you that isn't the case. The way I'm going to show you that isn't the case is the alpha isn't predictable, right? Now, obviously, that's true in the rational expectations world. It doesn't tell you, the fact that the alpha isn't predictable tells you nothing about the quality of the manager, right? But the idea can be used, because if I measure the manager's quality correctly, so if I measure value added correctly, that has to be predictable. Otherwise, there's something wrong, right? If you're skilled, you've got to stay skilled. So that's what I'm going to do. I'm going to now see, is value added predictable, right? So what I'm going to do is, every period, I'm going to pick a horizon, pick 5 years. Okay? So every period, I'm going to pick a 5-year, every 5 years, I'm going to do the following sort. I'm going to sort managers by their past value added. Okay? And then I'm going to divide them into deciles. And then I'm going to look at the value added in the decile over the next 5 years. I'm going to repeat that every 5 years. Then I have a value added measure for the whole data set, and then I'm going to average. I'm also going to do some other tests with a value added in a second, okay? So that's how I'm going to look at predictability, and we're going to do this over horizons from 3 years to 10 years. The reason why I can't do a horizon less than 3 years is I have to make sure that I use nothing from the sorting data set in the measuring data set, right? Which means I can't measure betas. So when I do the benchmark, I have to figure out the beta. So what I do is I'll project the manager's return onto the benchmark return. So onto the Vanguard funds, I get betas, and then I construct the benchmark from those betas. I can't use those betas that I've measured in the sorting data set in the measuring data set, right? Because they would induce predictability. So I have to measure the betas separately in both data sets, right? Which means I need enough data to do that, so I need at least 3 years. That's why the shortest horizon is 3 years all the way to 10 years. But look at these results. So this is, for each horizon, the predictability of the deciles, right? So here are deciles, 1, 2, 3. Here is the alpha of the decile in the predicted time period. As you can see, at every single horizon, the 10th decile beats the first, and it's also the highest decile. Even at 10 years, I can predict value added out 10 years, right? So it's highly predictable. And it doesn't matter. This is using the Vanguard benchmark, okay? But if you use the Farmer French risk adjustment, you get the same result. So it's highly predictable. Okay, so the problem is the t-statistic. There are problems with t-statistics. There could be problems with t-statistics. Because remember, I'm using dollars, I'm not using returns. There's all these issues. So the easiest way to deal with that is to just step away from it and set up a very simple non-parametric test, which is the following. The deciles, under the null, there's no predictability, which means the deciles are a coin toss. So that means the 10th decile should beat the first decile 50% of the time. It's a binomial distribution. So I can just calculate, based on that binomial distribution, the probability of the 10th decile beating the first decile, and then use that to calculate the p-values. So that's what's going over here. Top outperforms bottom, and as you can see, okay, this is the p-value based on those tests. It blows everything away, both times. Same thing with top in top half. The top deciles in the top half blows it away, right? So when you do the non-parametric test, you easily reject the null hypothesis that value added is unpredictable. This is the most interesting part of this picture. Look at the fraction of AUM in the 10th decile. This is always predicted. So when I calculate these things, I'm always looking at the predicted data set, right? And yet, so what does that say? It says investors know. They move their money into the best managers because the best managers have the top 10% of managers have a quarter of the capital. Okay. Now let's take a step back. Okay. This is out of sample compensation. So I look at the compensation the manager makes. What's that? That's the fee times the size of the fund. And what you find is that it's exactly as you would expect. That this is out of sample. This is future compensation based on past value added. Right? You find the 10th decile managers make much more than the first decile managers. Okay? Now, let's think about this, what this means. It means the only way that can happen is investors recognize skill. Because investors determine compensation. Why? Because compensation is AUM. So investors, in order for this to work, investors must know who the skilled managers are. Well, let's use that information. Let's instead of sorting by past value added, let's sort by current compensation. Let the investors decide who the good managers are. Yeah, one quick. No, these are all, this is the sort only on past value added. I haven't got to compensation sorts yet. All this is saying is, if I sort by past value added, and I look at the future compensation, I find that the managers who have done well in the past get compensated most in the future. And it's investors who determine compensation, which means investors know who the good managers are. Okay? Now watch this. So I'm now going to do the exact same sorts again. But instead of using past value added, I'm going to use current compensation. It's stronger. Here are the same pictures again. The first decile always beats the last decile, and it's always the highest. So that's not different. What is different is the middle. Before there was a lot more noise. It's now much more monotonic across the deciles. Investors are better able to figure out who the good managers are than I can as an empiricist. Okay? And to show that formally, I'm going to now do a monotonicity test. It's an easy test to do, right? You just subtract 10, 9, 10, it's supposed to, under the null it's a coin toss. So I subtract 10 from 9, 9 from 8, throughout the whole data set, and that will tell me what's the likelihood of the higher decile beating the lower decile. That's the monotonicity test. And you can see it is highly, highly significant, right? Most of these numbers are below, are 5 or below, right? So the past value added, start again. So this column is sorting by past value added. This column is sorting by current compensation. And this, you can see, this column does a much better job on the monotonicity than this column, right? So what that says is investors are better at picking managers than I can as an empiricist using past value added. One of the big results of this paper is it's exactly opposite to the way people think. It's not mutual fund investors aren't dumb. They are actually smarter than stock investors. And I'll come to why that is in a second. But just to start setting things up for the next paper, it's not true if you use the Farmer French risk adjustment. You don't get the same result. Okay? Right? So now, here I want you guys to start thinking about this. What could this mean? If I use the Vanguard benchmark, I get that investors are smart and they can figure out who the good managers are. But if I use the French risk adjustment, I don't get that. Right? So what could that mean? Well, it could mean one of two things. One thing it could mean is, well, if the Farmer French risk adjustment is correct, that says investors are leaving money on the table. Right? Because they're not correctly assigning capital to skill. Or, that's one alternative. The other alternative is, this is not the right risk measure. That investors don't really care about this measure. So that's going to be set up a test, which is, I'm going to say, you can use the mutual fund evidence to infer something about what risk model investors are using. So I'll come to that in a second. Okay, let's now talk about net alphas. So I promised you at the beginning that I was going to overturn the major result, but the net alpha is negative. So let's just look at it. So if you use the full data set and you use the Vanguard benchmark, then this is the net alpha. This is basis points per month, right? So what this says is both of them are not significantly different from zero because these are this is the T-stat, yeah? Okay? So this is 2 basis points a month if you use the equity weighted, if you equity weight across managers. If you value weight across managers, you get minus 1 basis point a month. Right? So that's 12 basis points a year. That's 0. So there is the net alpha across all mutual funds. If you use the full data set and the correct benchmark, you get 0. Yeah. It's the same thing. You're supposed to pay attention to past performance. It's information. What? It's information. If you pay attention to information, then It's the same thing. What's not surprising? I know you say that now, but Thaler used to walk around and say that was an example of how stupid they were. So you say now it's not surprising. I'm just telling you, before people figured out this equilibrium, they thought it was surprising. Right? It's like saying, after you explain to your grandmother that she shouldn't invest in the stock, she says, oh yeah, that's obvious. Sure, Granny, but you were about to make the investment beforehand, right? Yeah, so that's exactly the equilibrium. You expect the alpha to be zero. Now, let's look at why we didn't get that. So let's make two. You can do two things. First of all, you can snoop the data. Right? So you use only US equity. If you use only US equity and the Vanguard benchmark, then the equally weighted portfolio is still zero. The value weighted portfolio is negative and slightly, on the point is statistically significant. That's minus 5 basis points a month. That's 60 basis points a year. That's a big number. Right? If you then use the benchmark that doesn't have transaction costs in it, then you get the numbers that you got. Highly significantly negative gross alphas. And Farmer would like to look at this number and say, that the net alpha equals the fees. Like the way of really thinking about that is to say, no, you got it wrong, buddy. It exactly equals the transaction cost you're ignoring. Right? That's what's happening here. The net alpha is negative on the Farmer French portfolios because the portfolios don't have transaction costs in them. Right? So of course, it's going to equal the, yeah.
So in equilibrium, the net alpha for every fund, even for very well-skilled funds.
Yes,
right,
zero.
Zero. So from investors' perspective, I know the previous story wasn't right, but the end result is the same. They say all the money of the manager still, but he gets all the benefit, right? So investors chasing the performance still doesn't make sense.
Exactly. No, if you don't chase, if nobody chases performance, then you should chase performance.
True, but in equilibrium,
that's the fully competitive equilibrium. We use that all the time in economics. You open a grocery store, right? There are lots of grocery stores. The amount of money you make is exactly what you would equal if you work for somebody. The only way you can make money is if you have skill short supply. Capital does not have skill. What?
So this is the average for the whole sample.
Yes.
But if you sort this out into, deciles by skill, do you see the net alpha is actually positive?
No. It's negative. It's zero. I'll show you. There it is. So now we do exactly the same sorts we did before, right? We sort on, but you can either sort on past net alpha or past value added. This is value. It doesn't make any difference. You sort on past value added and you then look instead over the next horizon, instead of looking at value added, you look at net alpha of all the deciles. So you start with, the highest one and the lowest one, and yet nothing. There is no net alpha. There's no predictability in net alpha. Which is the way it should be. What do you say? Yeah, I know, this is what I'm telling you. This market is a better place to study risk than stock. It's in equilibrium. You look at it and it works exactly the way it's supposed to work. It's a miracle. Now, very seldom do our markets work the way they're supposed to work. This happens to be one of them. It works exactly as expected. Okay. Now, here's something interesting. Look at this. If you do the same thing, but instead of using the Vanguard adjustment, you use Farmer French, you do get predictability. Now, what does this mean? Well, it can mean one of two things. One thing is there's money left on the table. Right? There are positive NPV projects in capital markets. Right? That's the one possibility. The more likely possibility is that that investors don't care about this because they don't use this model. Right? So the next step I'm going to do is actually investigate that formally. Okay? And so this is just a formal test of that. So again, I can do top outperformance bottom and top in top half. So if you do top outperformance bottom on net alpha, you get almost no evidence of predictability. Okay? very little evidence of predictability, okay? But if you look at it, if you do it with a Farmer-French risk adjustment, you get strong evidence of predictability. Right? So what's going on there? Why is it that if you use the Vanguard, you get no predictability, but if you use Farmer-French, you get a lot of predictability? Yes. Where, what do you say? Where do you see the T-stat? The T-stats are like 0.24 or whatever. Though you can't, in these T-stats you can believe because these are return measures. But here, is this what you're talking about? Yeah. Where, over here you're talking about? Here. Is that what you're talking about here, this number here? This is a p-value. So this is not predictable. The only ones that are is like this one here, that one there, maybe. That one there. There. Little evidence. But if you look over here, these are all zero. And you look at these numbers. I mean, so what is this? This is the frequency, right? If it was a coin toss to be 50%. Right? So we're at 60% here of the top in top half, for example. Okay, so here's why I'm happy to give this talk. Because I would like to encourage people to think about the mutual fund database as a good place to study finance. And I'm going to give you two examples now of things that I've done in the mutual fund database where I've got financial insights about finance, right, that you couldn't get anywhere else, okay? And so let me show you. So I'm going to do two things, okay? So first of all, I'm going to use the mutual fund database to come up with a completely new test of risk models, okay? So let me explain, and I've already started talking about this, but let me do this more formally, okay? So, okay, let's start with the following principle. Asset pricing models don't come about by magic, okay? The reason why the asset pricing model holds is because investors must be using it. That's how they come about, right? So now, let's think about how we set up asset pricing models. So when we set up asset pricing models, we make two assumptions. We assume that capital markets are perfectly competitive. So there's an infinite supply of capital for positive NPV projects, right? And because there's an infinite supply of capital for positive NPV projects, that capital moves in, drives the NPV to zero, and in driving the NPV to zero, that sets the equilibrium. And that's where the asset pricing theory comes from, right? And there's also no asymmetric information. Okay. So, the investors are competing fiercely with each other. Prices adjust. So there's no zero NPV project. All projects are zero NPV. And in that adjustment process, that sets up a relation, which we call an asset pricing model. Okay. And the result is that the expected return of every asset is just a function of the risk. So now let's think about this so we're in equilibrium and then new information arrives. Okay. And so what happens generally is new information arrives. If prices stayed the same, there'd be positive NPV projects. So they have to adjust. So prices adjust. And how do they adjust? They adjust again to the new equilibrium. And you could ask the question, why don't we look for that when we test asset pricing models? So nobody ever says, look at the price adjustment process. Okay, and see if that is in fact the case. When the new information arrives, do prices adjust? Okay, so the problem, of course, is that there's no reason that there's any volume in that price adjustment process. So in the Milgram-Stokey paper, the prices adjust with zero volume. Okay, so it's hard to know what's causing the prices to adjust. The great thing about mutual funds is, as somebody over here pointed out, the price is fixed. And because the price is fixed, the only way things can adjust is through volume, through quantity. And so in mutual funds, you can observe the actual price adjustment process. You can observe the funds flowing. Okay? So, imagine this. New information arrives. If nothing happened, the asset pricing model wouldn't hold. So for model to hold, we need to see the flow of funds, right? So now let's think about how we're going to use that. Well, what causes the flow of funds? It is the fact that the manager beat the benchmark or beat his risk adjustment, his risk-adjusted return. So that means different risk adjustments are going to lead to different inferences. So if I look at the flow of funds, that's going to tell me which risk adjustment investors are using. That's what I'm going to do. Okay? So here's what I'm going to do. I'm going to take the standard set of asset pricing models that have been proposed. So every single model that's been proposed implies a particular outperformance for the manager. Right? Then I'm going to say, okay, well, that's how much the manager outperformed. Okay, now I don't know how much investors are going to update on that. If I see a manager's outperformed, I know that that's positive information, but I don't know how much. But I know it's positive. So I know I have to see an inflow of funds. I don't know how much I have to see, but I have to see an inflow of funds. So that's what I'm going to do. I'm going to say, okay, for every asset pricing model, for every manager, in every period, I'm going to measure whether he's overperformed or underperformed. If he's overperformed, I'm going to see if there's an inflow of funds. I don't know how much, so I'm going to +1 if there's an inflow, -1 if there's an outflow. But I know it has to be an inflow. And I'm just going to ask how many times do those line up for every asset pricing model. So it's a way of saying, what asset pricing model are investors using? Okay? So, okay, so here are, it's small. That's not so good. Okay, let me see. All right, so here is the result. So, this is the fraction of times things line up, right? So, under the null of randomness, it should be 50-50, right? 50% of the time, the inflow of funds should match. So if I see a positive outperformance, I should see a inflow of funds if it was random. Right, so anything above 50 means it's not random. And so you can see, I'm going to talk about all the models I test in a second, but you can see this is above 50 for every single thing I test. So what that says is I can't reject any of these possible models. But then I can ask the question, which model does best? Okay, let me just go through what I've done here. The first line is the CAPM with the crisp value-weighted index is the market. The second line is the CAPM with the S&P 500. Now, this is a set of what I call no models, okay, naive models. So the first one is just the raw return. Is the raw return in the fund positive? Okay, if it's positive, then I see if there's an inflow, it's negative. So that's the first person. That's a pretty naive model. Then the second model is the excess return. That's like investors are risk neutral. They just compare against the risk-free rate, right? So if the manager beats the risk-free rate, inflow of funds. Okay? The third possibility is the market. Now, this is not the capital asset pricing model. Okay? This is the investors beat the market. Sorry, the manager beats the market. So if the manager beats the market, you get an inflow of funds. That's not the CAPM. Because the CAPM is not the market. It's beta times the market. Right? So these are the three models. Then the next two are the farmer French. So it's farmer French without momentum, farmer French with momentum, and then the dynamic equilibrium models. What you see is the capital asset pricing model wins in all cases. So of course, so let me talk about what the horizon means. So if I want to see, so there's going to be a a period of time when the investors measure the alpha, and then a period of time when the funds flow. In perfectly competitive markets should be instantaneous. But most likely the real world isn't instantaneous. So what we do is different horizons. So the 3-month horizon, so we look at the alpha over 3 months and the flows over 3 months. So that's close to instantaneous. All the way out to 4 years. So it takes 4 years. So alpha over 4 years, flows over 4 years. So those are all the horizons. And as you can see, no matter what horizon you pick, the capital asset pricing model wins, and this is statistically significant. Now, the most interesting thing here is this number here, for example. The CAPM beats the market. That, to me, was the biggest surprise. If you told me, look, I'm going to find that a CAPM does better than Farmer French, I would have said, well, okay, I'm not surprised that nobody knows who uses that model, right? But the CAPM does better than the naive model of just use the market. In other words, this is saying investors adjust by beta, right? And that, to me, is a huge surprise. This is evidence that, in fact, investors are using the capital asset pricing model. Okay. So I've got about 15 minutes. I'll leave a little bit of time for questions. I'll quickly do the second paper. So that's the first paper. You can use the mutual fund database to measure which asset pricing model investors are using, right? Now let's talk about corporate finance. Okay, so in corporate finance, there's a big question, which is what are the role of firms? Okay. There's all these theories on the role of firms. They don't do so well with firms that are pure human capital firms. Okay, so why do pure human capital firms exist? So obviously a mutual fund company is an example of essentially a pure human capital firm. So why is it good to put this human capital together? Here's the answer. What I'm going to show is we know the names of the managers who manage the funds of a mutual fund company. What I'm going to show you is when the firm moves managers around, that creates an enormous amount of value. Okay? 30% of the total value added in the industry can be attributable to the executives' internal decisions in the firm to move managers around. And in fact, I would argue that is why the market seems so rational. I showed you the funds always flow to the best managers. You're going, well, how do investors know who the best managers are? What's really happening is there's an intermediary, the executives of the firm. So investors invest money in funds. Now, what happens is the following. If the managers of the firm know their own employees much better than investors, if they see an employee who has too little money under management, what they do is they give that employee more responsibility. So they give that employee another fund to manage. If they see an employee with too much money under management, they take away a fund. And in doing that, they correctly assign the amount of money under management to the employees and create an enormous amount of value. So let me show you that. Okay? So I'm going to use internal manager moves in the fund, and I'm going to measure, once I see an internal manager move, what happens to the value added of that manager going forward. Right? So we measure the value added of every fund, right? So they are funds. I can only measure the value added of the fund. Then, funds have multiple managers. So I assign the value added of every fund equally across the managers. Every manager gets 1/nth of the value added, okay? Then some managers manage multiple funds. So I then add up for that manager, his value added across all the funds he manages, and that's the value added of the manager. And then I'm going to ask the question, what happens to the value added of the manager when I assign the manager a different fund to manage? Okay? So that's the panel regression, right? So I do the value added of the manager, and I'm going to put a indicator variable. If there was an internal decision, if the manager was assigned, okay, and I'm going to divide that into two dummy variables, which is either a promotion or a demotion. A promotion is the manager is assigned a new fund and the overall assets under management that the manager is responsible for has gone up. Or the manager is assigned a new fund and the overall manager has gone down. So up means promotion, down means demotion. Okay? Here's what you find. So The capital reallocation decision adds $681,000. Okay, so anytime a firm does a capital reallocation decision, it adds value, and you know the promotions. So if you divide it up by promotions add value. So do demotions, right? You expect that. A demotion's also got to add value. Every decision the firm makes has to add value, right? The demotions are not statistically significant, and the reason is it's a sense of data. If the manager is fired, I don't get to see the future data. We do an adjustment for that, and when we do the adjustment, the demotions are significant too. Here's something interesting. I can look at what happens to the value added of the managers in the fund who weren't either promoted or not. You find there's a positive effect. So when the firm changes the managers, the other managers in the fund, that has a positive effect on the surviving managers in the same fund, right? So there's an externality. So in fact, this number, that top number, underestimates the total value added because you've also got to add this number to it as well. Okay, so managers in the fund who are not promoted and demoted do better when another manager in the fund is either promoted or demoted. Questions? How much time? Probably 20 passes when I'm supposed to be done, yeah?
So clarifying question
Yes.
about your value-added measure. And so in equilibrium, so the net alpha is 0. So the gross alpha more or less equals the fee. Then the value-added measure is the fee times
In equilibrium. In equilibrium, the value added is fee times yes.
the fee times the
Yeah.
basically that is the manager's pay.
Yes.
So if the value-added, basically the manager eats what he gives.
Yes.
And then that means in the bargaining, in the bargaining between the managers and the fund investors, managers have the dominant
Because
power.
exactly. Because there's an infinite supply of capital for positive
Very
NPV.
short supply of skill.
Exactly. That's obviously the world. You can't. It's hard to make money in markets. Have you ever tried? Every time I've tried, I've lost money. Okay.
Related to the question is, what do you think about the hedge fund industry? To me, a main difference in the pay structure is the manager and investors, they share the alpha. Because of
They don't. The pay structure doesn't necessarily mean they share the alpha.
But think about the incentive fee, right? Every dollar of alpha the manager makes, the manager can keep only 20 cents and giving the 80 cents to the
Yeah. But you've got to think of that as a payoff for the option. So an expectation. Now, okay, there are two different principles here. First of all, does the hedge fund contract allow the manager to extract all the rents? Answer yes, because it's an option. So if they, in expectation, they get, so it's true they give up the alpha to the investors, but the investors pay the fixed fee, right? So when they don't do well, the investors lose. So if you compute the expectation like any option, then the manager can extract all the rents. Now, having said that, I don't think the alpha is zero in the hedge fund industry. Okay, and the evidence is that it isn't. The evidence is that it's positive. Okay, the problem with that evidence is, unlike the mutual fund industry where the data set is audited, the hedge fund industry, the data set isn't audited, right? So you don't know whether that data is correct or not, right?
But they still face kind of a legal implication, right? If I'm an investor, I see the report to the database say they gave 10%, but I receive only 3%.
I just referee a paper. No, I didn't referee a paper. I just read a paper that shows that shows that there's a lot of manipulation of hedge fund returns, right? So managers, because they have leeway, can report returns that are higher than they actually are, and then later on, that aside, I still think that the alpha should be positive in hedge funds. And the reason is that the hedge fund contract is a very difficult contract because the manager can give himself a pay raise by just taking on volatility, right? which means that investors have to monitor the managers, right? Well, there's a cost of monitoring. So the alpha has to be positive to compensate investors for their cost of monitoring, right? Yes. So the other thing I would say is, I mean, look, when we made the assumption that there's no asymmetry of information, right? We didn't do that because we thought it was a realistic assumption. We did that because the model was simple to do that way, right? In the intervening years, though, I've come to the conclusion that, in fact, that's not such a bad assumption, that even managers don't know their own ability, right? I don't think that's true in hedge funds. I think in hedge funds, there's more likely the manager does know his own ability. What do you say? Yeah. I mean, I think I've thought a lot about writing down the equilibrium for hedge funds. I haven't actually succeeded because I have never really understood why the hedge fund contract is the way it is. Why is the contract that way? Why isn't this option contract? You know, I don't understand that. I've never been able to understand why that. I mean, in mutual funds, the contract is optimal. I mean, that's one of the surprises that comes out of the paper with Rick. The contract is optimal. It's the optimal contract. The reason it's the optimal contract is if you might think, as people did before, that the optimal contract should compensate managers based on performance, right? But we just agreed in expectation the alpha is 0. So if you compensate managers on performance, you're compensating managers on luck. Whereas if you compensate managers on the size of the fund, we've agreed the size of the fund does measure quality. So that's the right measure. And so the contract is the correct contract to use. You do want to compensate managers on the size of the fund. The question is, why in hedge funds don't we see that? Well, they can, but they choose not to. No, they choose. The lockups are endogenous. So that's part of the contract. Because I can tell you, when things are not locked up, then they are even more sensitive. Hedge fund investors take the money out quicker than mutual fund investors. But you're right. Why do we see lockups? Why do we see high watermarks? Why do we see all that? That would be, I would like to be able to solve that problem. Well, I've assumed they know the asset pricing model, so they've taken it out. Yeah. There's no asymmetric information. All investors like positive NPV projects. So that's well, no, preferences are irrelevant, but every investor wants a positive NPV project, regardless of their preferences. But there's no difference in information. Right? Because if they'd say, I somehow know that, I don't know how I do this, but I know that the true asset pricing model is this one, and you don't, then we may be using different asset pricing models. I'm assuming that away. So I'm assuming that investors only care about money. And it's not a bad assumption. ESG stuff is pretty bad. Oh, I mean, you can assume whatever you want. Whether it describes the real world or not, I think is an empirical question. Yeah.
So when you calculate gross alpha, it's based on gross returns. And they would be net returns which are reported in the increased database plus the fees. But in this, you would calculate, you probably even underestimate what is really happening because it's only a portion of the fees that is reported.
No. So one great thing about the mutual fund database is that it's actually audited, right? So the way fees are calculated, they don't calculate the fee from the percentage. It's the other way around. They take the total amount of money in the fund, and they take the total amount of money that was paid out in any way, shape, or form. And they divide, and that's what they call the fee. Right? So in fact, those are accurate numbers. I mean, because the SEC requires it. Yeah.
Again, we add the alpha measure. So here we use the simple average. So basically, when you get to the alpha average, you do the simple average. So will that create a problem compared with using the geometric average?
Well, if I want to know what the expectation is, I want to use the arithmetic average, which is what I'm doing there.
But the investor, they put the money into the
They get the geometric. No, it's true, they get the geometric. Yeah. But that's not the question I'm asking. I'm asking what's the expectation. Right. But it's true, that's a different calculation. Okay. Thank you very much.